Hello, Super Saver. I hope you're healthy and well this week. So it seems bank bail-ins are another topic that's on some of your minds lately. Yes, I do see those messages and emails that come through from our community, as well as the generally supportive conversations that happen in the comments section as well. So thank you. The topic seems to be top of mind for many after bail-ins were mentioned in passing in this leaked FDIC video that turned out to not have been leaked at all. If you want to understand the real truth behind what happened at that FDIC meeting, then check out this video that we posted a few days ago. I've linked it in the description below as well. So in today's video, I'm going to cover what's the difference between a bank bailout versus bail-in, how to protect your money if a bail-in does happen, and what happened in the last bail-in. Many of us are familiar with a bailout, where an external party, typically the government, using taxpayer money for funding, steps in to save a financial institution from failure. One of the most notable bailouts was insurance giant AIG in 2008. During the financial crisis, the government's overall support for AIG totaled $182 billion of taxpayer money. In this case, though, things actually turned out well. Here's the $182.3 billion of taxpayer money that the government injected into AIG in 2008. And here's how much they got back 4 years later, exactly $205 billion. So the government and we taxpayers made $22.7 billion of profit on this bailout in the end. Having said that, not all bailouts automatically result in positive outcomes for taxpayers, and the sums of taxpayer money that were used in these bailouts were simply staggering. So the result was not just that the financial institutions were saved from failing, but also a very loud public outcry over these massive bank bailouts. As a consequence, Congress passed the Dodd-Frank Wall Street Reform and Consumer Act in 2010 with the idea of effectively ending bank bailouts once and for all. And that's when bank bail-ins were born. Bank bail-ins serve the same purpose as bailouts, to save a financial institution from failure, except it's not with taxpayer dollars. It's with dollars that are already in the failing bank from unsecured creditors, bondholders, and certain depositors. Don't worry, Super Saver, if your bank deposits are below the $250,000 limit per depositor, per insured bank, for each account ownership category, it's protected by the FDIC, by the Federal Deposit Insurance Corporation, and you should not suffer any losses from a bail-in. If, on the other hand, you have deposits at your bank that exceed the $250,000 FDIC limit, then those excess amounts can be used as part of a bail-in if your bank ever fails or comes close to failing. In a nutshell, when there's a bail-in, the bank effectively cancels excess depositor amounts in parts or in whole, as well as the debt held by other unsecured creditors and bondholders, and converts these amounts into equity in the failing financial institution. And by the way, this idea of using some or all of creditors' money to help save a failing business is not as new as its name. It's been around in distressed situations for a long time and was usually called a debt for equity swap before they coined the new label of a bail-in for what's essentially the same old concept. So, here are the two implications of a bank bail-in. One, the failing bank now has more cash on hand to keep things running, and hopefully will use this money wisely to keep it from failing and restore its economic health for the benefit of everyone. For example, to attract new clients with promotional offers or find other sales channels. Two, the bondholders, other unsecured creditors, and depositors with excess amounts at the bank above the FDIC limit lose some direct cash, but are now partial owners of the bank because their money has been converted to equity. Now, the rationale behind a bank bail-in also appears to be twofold. One, unsecured creditors, bondholders, and depositors should, in theory, prefer to keep the failing bank in business rather than risk losing all of the money that's due to them. Plus, they have a chance to participate in a successful turnaround as they are now equity owners in the institution. 2, it saves taxpayers money and risk because they're not the ones paying to rescue the bank. It's the unsecured creditors, bondholders, and depositors with excess amounts at the bank above the FDIC limit who are paying for the rescue. There is one more thing to note about bank bail-ins, and it's that derivative claims come before unsecured creditors, bondholders, and depositors, meaning those claims will be paid first before claims from unsecured creditors, bondholders, and depositors with amounts in excess of the FDIC $250,000 threshold. Given how important derivatives have become in financial markets for managing and allocating risks, our lawmakers decided to give them preference in the event of a failure, because doing otherwise would cause even one bank failure to spread further and to contaminate the wider financial markets. And that systemic risk is what giving derivative claims preferential treatment is trying to avoid. So now that you know what a bail-in is, let's talk about how to protect your money if a bail-in does happen with your bank. This one is pretty easy. Make sure you stay under the $250,000 FDIC limit. As I mentioned earlier, so long as your hard-earned savings stay below this threshold, that money is protected by the FDIC. If you have more than that in one account at your bank, well, first, congratulations. And second, make sure you spread that money out, either across different accounts with different account ownership categories at the same financial institution within the FDIC rules, or better yet, across different financial institutions altogether. Here's some FDIC coverage basics from their website. FDIC insurance covers depositors' accounts at each insured bank, dollar for dollar, including principal and any accrued interest through the date of the insured bank's closing, up to the insurance limit. And if we scroll down, we can see that the standard deposit insurance amount is $250,000 per depositor per insured bank for each account ownership category. I've linked the FDIC website below for those of you who want further information. If you want me to do a deeper dive than this, then drop a comment below and let me know. Now, let's talk about the last time a bail-in actually happened. So here's the good news. I did some digging, but wasn't able to actually find a recent real-life example of a bail-in in the US since Dodd-Frank was passed. Now, if someone in our Super Saver community has their detective cap on or is aware of one, then do drop a comment below and let the community know. Even globally, the only notable bail-in of a financial institution I did find seems to have occurred in Cyprus in 2013. And this was possible because Cyprus is a member of the European Union, which has been implementing similar bail-in concepts as the US after the last financial crisis. According to Reuters, in this instance, bank deposits above 100,000 euros, which were not guaranteed by the state under EU law, were frozen and used to rescue 2 Cypriot banks. That was Cyprus in 2013, though. For us in the US, the roughly 1 decade between the last round of bailouts during the Great Recession and when COVID started, that period was overall a boom time for our economy and the markets. So the fact that we didn't have many bank failures nor any notable bail-ins should not be a surprise. But this also means that a bank bail-in as a concept has yet to be tested in practice in the US. And it's hard to predict how exactly this might all play out when it happens for the first time. I hope we don't have to test this out anytime soon, but if or when it comes to this, I'll be watching the space and reporting back as usual, so stay tuned. All right, Super Savers, I hope this video has helped you better understand what a bank bail-in is, as well as how to best protect your hard-earned savings at your bank if a bail-in ever happens. As always, if you enjoyed this video and learned something new, then don't forget to share it with those you care about. And of course, hit that thumbs up and See you again very soon with another brand new wealth building video.